Welcome to Street Check, the best podcast in the history of Cabot Wealth Network, which has been delivering investment advice, research, ideas, stock picks since 1970. I'm Chris Preston. I'm Chief Analyst of Cabot Stock of the Week and Editor-in-Chief.
And I'm Brad Simmerman, the Web Editor and Chief Analyst of the Cabot Wealth Daily newsletter. This week, we are going to get started with our big three. We're going to talk about the potentially pending government shutdown, the acquisition of Splunk, and then the rally in cannabis and the subsequent Senate Banking Committee news. Safer bill came out. So we're going to check in there. After that, we're going to make 5 fourth quarter predictions. They're sure to be wrong, following in the footsteps of our second half predictions that actually aren't that terrible. I think
they weren't as sure to be wrong as we thought.
They weren't sure. Yeah, these are sure to be wrong.
Yeah.
And then, but before that, what we got to start with.
Before that, we'll, as always, we do our defend the take. Speaking of predictions, sure to be wrong. And this one actually is a follow-up. It is a sequel to one of your takes that was wrong. When was that you said that the S&P would dip below a certain number before rallying to another number?
May?
I think the rally part you got right. Was it May?
May. I think it was late April, maybe mid-May. I don't know. These are starting to run together, I think.
Okay. Yeah. I mean, you got the rally part of that right, at least. So this is a similar one. This is a callback. Your defend the take is that the S&P 500, which at the moment is trading at just over 4,300, will dip below 4,200 before it breaks above 4,500. You have 90 seconds. Go ahead.
Yeah. So as we established, this is a throwback. We're dusting off the old chestnut. I'm going to fall on my sword for the market here, and I'm going to lever my counter indicator powers to call that the S&P is going to decline below 4,200 before it breaks above 4,500. I can't say like that this is a super hot take, right? If the government shuts down, the optics start getting really bad. Everybody's sort of settling into the reality that interest rates are high and they're going to stay that way. I did see a compelling case, and we'll touch on this later, for the S&P to be valued closer to 3,000 than where it is now, which obviously would be a major sell-off. But that's based on earnings weakness going forward and then historical valuations using a Shiller index. I mean, you can sort of rely on those valuation metrics only so far, right? Ultimately, market sentiment sort of overrides that. That's why stocks get overbought and oversold. But I do think that we've got some weakness ahead. Consumer spending was actually revised lower to roughly half the prior levels of growth for the second quarter. So we are starting to feel the pinch. Consumers are actually seeing the real interest rates hit their lifestyles now. They're seeing more credit card or higher credit card rates. They're going to be seeing student loan payment resumption. There's a lot of really bad optics going into the fourth quarter. And as much as October can sort of can be a market bottom, and very well could be, I do think that we're starting to see indicators that the consumer strength that we've been leaning on for so much of this year is starting to peter out.
All right. You sort of hit the post. I gave you a few extra seconds. Nicely done. I agree with you. I mean, it looks like the government's going to shut down, but who knows? We won't know for sure till our next episode or early next week. And we'll get to more of that in just a second. So yeah, like you said, it'll depend. The 4,200 part of your thesis may depend on that. But even, it losing another 100 points from here. I mean, it was in the mid 4,200s as of 2 days ago, 48 hours ago. So I could definitely see that happening. We may not have hit lows yet, or may not have bottomed yet. The 4,500 part, I definitely agree with it rising to 4,500. And actually, that's going to be part of one of my predictions. So I don't want to step on that too much. So generally, I agree with you. But if you miss out on any, especially the 4,200 part, I'll deny it completely and just pin it all on you like last time.
That's fine. This is a public service that I'm doing. I am trying to will the market higher.
Yeah.
I'm relying on my spoiler characteristics, and I'm trying to juice a rally. And hopefully
Yeah.
it works. Hopefully I'm the wrongest man on the internet and the market goes to 5,000 tomorrow and everybody's rich. Hopefully that's the case, but I think that this weakness is going to feel a little bit stickier than maybe some of the bulls are hoping.
Yeah. Okay, so let's get to our big three, and that starts with number one is the looming government shutdown Sunday. Sunday, what time? Midnight? Is that when it would?
Yeah. No, it
Government...
would be tomorrow at midnight.
Oh, Saturday. Okay, right.
Yeah.
Saturday.
So Sunday at
Yeah,
12:01 a.m. Right.
okay, so we're 36 hours from that. So will it happen? Won't it? I don't know. But let me just so I want to give some data on the last two times that the government shut down for more than just 2 days. So it's shut down three times this century. One of them was just a two-dayer in January 2018. So I'm going to leave that out of it. Times it shut down for more than for weeks. First, 2013, it shut down for 16 days. This was I think this was the Ted Cruz green eggs and ham filibuster thing. I don't really remember. I remember that him reading green eggs and ham, I think. But I can't remember. Apparently it was in the context of the government shutdown. Stocks, S&P during that time was up 1% in those 16 days. 2018 started December 21st, 2018. This was over, I think Trump wanted to build the wall and was holding government hostage because of that. I don't really know the details. It doesn't really matter. 34 days government was shut down. I don't remember it being that long. I do remember it being long, but 34 days. You know what the S&P did during those 34 days? Up 10%.
I was going to guess like 4%, but
okay. So now stocks did pull back a little bit each time when the government shut down. I expect to see that next week if it does shut down this time, and it may well dip below 4,200, like you said, the S&P. But I don't think it's going to be, it's pretty much priced in at this point, or at least most of it is priced in. So I don't think this means, some death knell for the market. Even this, look, it lasted more than a month 5 years ago, and stocks were up. So I don't know that there's something to be, just hiding under a bunker because of, converting all your stocks to gold.
Yeah, no, I think that's the right takeaway. I believe the numbers that I've seen are from Goldman Sachs saying that on a per week basis, GDP takes a 0.2% hit to the growth rate, but that's quickly reversed when the government reopens, because essentially all they do is accumulate IOUs for government contractors, for employees that are continuing to work without paid. I mean, it's not as if it's money that's being sucked out of the economy. It is, like you said, with the initial couple of days of the shutdown, it's a bad optics problem. So I mean, you'll see some noise, but fundamentally, it doesn't revalue stocks. I don't know. Like, so here's the thing. It's with pricing it in, we're coming off of what has been sort of the most widely predicted no-show recession ever, right? And this is one of the most widely predicted government shutdowns that we've probably ever encountered. I don't think anybody is really honestly expecting that we'll get past this without the shutdown. So there is maybe some question as to how efficiently it's priced in, or how effectively it's been priced in, right? Maybe there is a little bit of weakness, or maybe it's overpriced in and we actually rally when people go to work on Tuesday and realize that their life hasn't materially changed because the government's shut down. So there's that element to it, certainly, but as far as the fundamentals underlying the markets, the biggest thing that I've seen that will actually affect equity markets is the SEC essentially came out and said, hey, government might be shutting down. If you were going to IPO in October, try and get your IPOs filed and trading before, right? So there were a couple of companies I saw that were really small that had launched. There have been a few funds launched as well that are probably quicker to market than they otherwise would have been. So, I mean, we're coming on the heels of what, 2-3 weeks talking about don't buy IPOs in the first couple of years that they come out. So, all right, if you're following that recommendation or if you're following that suggestion, then you're unimpacted anyway. If you're not, I would just be extra careful around maybe some of the rushed IPOs, especially smaller ones that have come out in the last couple of weeks, because some of those might have been shoved to market quickly just to avoid the shutdown, and it maybe not subject to as much due diligence by the broader investing community, by the market as a whole.
Yeah. Okay, let's move on to number 2. As you mentioned, Cisco is bought out, or sorry, has a deal in place to buy out Splunk for, I believe, $28 billion.
Yeah, $157 a share in all cash is the acquisition term.
157 a share, which right now Splunk is trading at
about 146 last I saw.
146. So it's still shy. It had a run up, but it's still shy of its 157 deal price. I guess a few takeaways. So one, I want to mention, just owning takeover targets, period, is always good business. It's hard to identify them unless so our Jacob Mintz, who's our longtime options trader, been on this podcast a couple times. It's his podcast, Ombudsman. He has a unusual options trading activity scanner.
Yeah.
Where he is able to, if he sees a lot of call buying in a certain stock, he's like, something's up. Well, he saw a ton of call buying in Splunk, a stock that he was not really on his radar prior to this. And so he recommended to buy calls in Splunk. And what the result has been, sure enough, it got bought out, and the result has been a 170% gain for his subscribers to Cabot Options Trader. Or sorry, it's in one of his other services. But anyway, the point is, if you want to identify these things before they happen, I'd recommend signing up for any one of Jacob's newsletters, Cabot Options Trader, Cabot Options Trader Pro. But also, do you have any other ways that, aside from buying companies that have rumors of a takeover, of being a takeover target, what would be your advice on trying to identify these that could have paydays come down the pike?
That's really really tough. I mean, so do you know what month Jacob's month his bull call spread was when that expired?
Let me see. You keep
So as you look that up, so what we're seeing with Splunk, it's trading at a 7% discount to the acquisition price. That is essentially pricing in that it's going to take about a year to maybe a year and a half for this acquisition to close, to clear all the regulatory hurdles. If you look at what was it? It's Broadcom it was VMware, I believe, is their acquisition. Or it may be reversed. I don't recall specifically. They're over a year in what is sort of a similar vertical acquisition where it's not, it's not really at risk of government of monopolistic monopolistic treatment by the SEC, but it is a sort of a vertical integration that allows them to grow market share. But I believe what the market is pricing in is about a year or so for this acquisition to go through. And that's just based on the 7% return. Your risk-free rate right now to just be in a treasury or to be in cash is about 5%. If there was suspicion that this acquisition wouldn't go through because of regulatory issues, it'd be trading at a deeper discount. If there were thoughts that a higher competing bid might be coming through, it would be trading closer to the acquisition price or potentially even above it. But where it's trading right now is in my mind pricing in an expectation that this deal will be completed on the terms that were already outlined, and that it's just going to take a year and change to do so. So you're seeing a little bit of a discount there that is higher than you would have seen in years past, but that's simply because the risk-free rate is higher. because what this is setting up is an arbitrage opportunity. You could go out and buy shares of Splunk right now at 146 and be not guaranteed, because there's no guarantees in the market, but you could be as close to guaranteed as possible that you're going to make 7% on that trade, and it's being valued as such. As far as being on the lookout, oh, I'm sorry, do you have Jacob's?
Well, yeah. So he made the trade. It does not have the I can't find the expiration on it. But he bought the calls on Splunk on September 12th. The deal went through on the 19th, 20th, or at least the spike in shares happened on the 20th. So, or sorry, 21st. Yeah.
Yeah. So I think what his subscribers are, they're up 170% on the calls. They could potentially be up even higher if there's an indication that this deal's going to go through quickly. But in all likelihood, that's going to probably cap their profit. Maybe they drift a little bit higher, depending on how long it is. But Jacob doesn't normally go out far enough to probably see this deal all the way through to completion. I mean, sometimes he'll buy leaps that are going out more than a year. So like maybe they have a January of 2025 bull call spread, or January 25, and like there's a diagonal component to it. But in all likelihood, they're not going to realize the 157 price, but walking away up 170%, you're pretty happy, even if you don't get the last 10% or 20% on the trade. As far as
especially in the middle of what's been happening in the market in
the
last couple of weeks in September. Yeah.
170% return on a trade it's certainly a month maker. It's probably a quarter maker, and it could be a year maker, depending on how heavily heavily invested his subscribers were. As far as attractive acquisition targets, low debt, lots of cash on the balance sheet are two things that help. Sales growth obviously helps, right? You're most likely not buying companies that are mediocre or that are underperforming unless you can strip them for parts and you can piece out the corpse of like a zombie company, right? You can buy Sears and then sell the real estate, and then you sell the brand name, and you sell. Do you remember what line of tools Sears had? They had like a proprietary brand.
Oh yeah, I can't think of it, but yeah, I know what you're talking about. Yeah,
I should know this. I used to sell hardware. There's another Brad fact.
Yeah, there you go. Fun Brad.
There you go, Jacob.
Yeah.
So anyway, whoever bought Sears sold the brand of Craftsman. They sold Craftsman to, I think, Stanley Black & Decker, right? So you can buy these zombie companies and piecemeal them out for more than they're worth, but that's not really what you're looking to do with the acquisition target thing, because that's really more of a bottom feeding. So strong balance sheets, low debt, and then a natural product fit. Paying attention to what some of the acquiring companies are saying in their quarterly reports, in their press conferences, in their press releases, all that. If Apple's coming out and saying, yeah, we want to in-house some chip making supplies, all right, well, maybe they're going to need to buy somebody that's in that food chain. That's one thing that you can look at to potentially find an acquisition target, but it's very, very specific, and it's really tough. And it should be obvious that it's tough, because if it weren't tough, stocks wouldn't run up 30, 40, 50% on acquisitions. Everybody would already be able to do it, and they'd be valuing it appropriately in, sort of flies in the face of the efficient market hypothesis. But
so, okay, let's move on to number 3. You mentioned cannabis, something we've talked about a bit in recent weeks. We had Michael Brush, who runs our Cabot Cannabis Investor Advisory, on a couple of weeks ago. Big spike in cannabis stock after 2.5 years of just being pummeled down like 85%. Had a big spike at the beginning of, end of August, after it was announced that the FDA was recommending HHS
and the FDA
was recommending rescheduling cannabis from being a Schedule 1 drug to a Schedule 3, which means less harmful. Schedule 1 is in there with heroin, LSD.
Yeah, no medically demonstrated benefits to it.
Right. And now the second catalyst, so that sent cannabis stocks soaring. Second catalyst has been the Safe Banking Act, which would give cannabis companies rights to banking, basically, so they're just not all cash businesses. And that made progress. This week was approved in the Senate banking committee.
Yeah, evidently, and I haven't seen distinctions between the originally proposed sort of safe banking and evidently the bill that it came out safer banking. My
Maybe it
guess
sounds
is
better. I don't know.
Well, they probably stripped out some of the social justice provisions, things like prioritizing minority community members as getting grow operation licenses or dispensary licenses. Maybe removing some of the provisions that would commute sentences, things like that. I haven't seen the pure text of it. I do think that pending government shutdown is backburnering any kind of positive impact from this kind of regulatory move.
Yeah.
Michael wrote an article for us earlier this week talking about one of the other benefits of rescheduling is that these cannabis companies are not subject to IRS code 280E, which prohibits them from deducting some of their operating expenses for selling deducting some of their business expenses to offset some of their sales receipts. And the 280E would also allow the relief from 280E would allow these companies to take advantage of net operating loss carry forwards. So if you've been losing money for, say, the last 2 years, which most cannabis companies have been doing, they've been accruing these net operating losses. If they start turning a profit, and if it's rescheduled and if cannabis is rescheduled, they can use those net operating loss carry forwards to offset profits going forward, and they can take a big bite out of their tax bill, which is going to improve some profitability there. Michael outlined the 5 companies that have the most net operating loss carry forwards in the article. So I would encourage you to take a look at that if you're interested in the cannabis sector.
Yeah. And it seems, I guess my overall takeaway is this. So there's this big run up in the sector at the end of August and into early September, which is in contrast to what was happening with the rest of the market. I think what's been equally impressive is that while the ETF, the main ETF that tracks the index, MJ,
right.
has given back about 20% of its gains. It was up, what was it up, like 50
60 58
58% in less than a month. It's given back about 20% of that. Honestly, I would have thought it would have given up about half its gains, just given really the sector's history of just like false starts over the last 2.5 years, but also just how much the market has pulled back in the last couple of weeks. So the fact that it's kind of holding its gains is impressive. And it seems now that there used to be, up until a month ago, there was no real backstop other than just growth and sector growth and hope that was supporting any rally in cannabis stocks. Now it has 2 backstops with the rescheduling that could happen by the end of this year. It needs approval from the DEA. Or at least early next year, and then the prospect of Safer Banking Act. That's 2 things sort of backstopping the rally. So it seems like this one has a little bit more teeth, and it might be enough to take a flyer on a cannabis position. Even if it's just small, dipping your toe in. I think Michael said in his recent issue that there could be some short-term pullbacks since there hasn't been a ton yet. And because the government's about to shut down, like you said, there's not going to be movement in the next few weeks, potentially longer. But, these are positive developments for the intermediate to long term for the industry.
Yeah, definitely. I looked at the performance. It was up 61% from the August lows on August 28th to September highs on the 11th. 61.5% is what MJ was up. It's now up
2 weeks.
As of the close yesterday, it was up 29%. Right now, it's a little bit softer on the day. So, it did give back about half of its rally, which is not uncommon. Typically, that's what a retracement looks like. Some
Yep.
people will use like Fibonacci lines, which has, I believe, a 58.7% retracement level, or 54 point, I don't know, it's some fractional percentage in the mid to high 50s. But a 50% retracement on a strong rally is solid. My takeaway from it is still that there's probably a lot of industry consolidation ahead, because these changes that are coming, rescheduling might not happen till next year. State legalization is a multi-year process. So all those early investments, they're on a ticking clock, and it'll take a little while for us to see the full effect of rescheduling, legalization. The tax benefits we were talking about, those are only beneficial if you're turning a profit. So, the passage of safe banking would then allow them to start, maybe it would allow them to operate more profitably, and then the 280E thing comes in. So because I think we'll still see more consolidation in the industry, I think the safe bet is gain exposure via an ETF. Something like an MJ is perfectly appropriate. It's giving you broad-based exposure to sector trends without taking on disproportionate risk in the operating performance of any one company. The other thing to target is, if you're looking at individual names, look for companies without a lot of debt. Companies with a lot of debt, even with a lot of cash flow, are probably holding debt from the last few years when rates were effectively zero. If they have to refinance that debt, they will refinance that debt at today's prevailing rates, and that makes operating conditions much harder. So if you love an individual stock and there's a lot of debt, start looking into maturities, see what the terms of those debt are, because that's going to be an operational issue for you in the future. Or just look for companies with no debt.
Okay, let's move on to fourth quarter market predictions. Sure to be wrong. Before we do that, as always, if you have any questions for us, you can email us at street questions or comments, complaints, whatever, streetcheck@cabotwealth.com. We did get one mild complaint last year, our ethics, intertwining of ethics and investing.
You know what? Yeah,
which we expected.
Since that came up, let me address it. We should have done a better job of outlining that our opinions on this podcast are our opinions, and they're not governing guidance for Cabot advisory. So if we say, hey, we wouldn't buy this stock because we have an ethical issue with it, that's not Cabot's position, that's our individual position. So we could have done a better job clarifying that, and we got called out for it, and we apologized. So hopefully, yeah.
We'll so if you have more complaints, streetcheck@cabotwealth.com. Also, or you could be, if we're going for more positive reviews, leave a review, 5-star rating, subscribe. It's always good. And, or give us a like, whether you're listening on Apple Podcasts or watching on YouTube or wherever. It's always helpful. Okay. So predictions, I'll start. My first prediction. So we each have we sort of each have 3, but I'll start with my first one, and it's that Q3 earnings, which are coming up. The earnings season starts in about 2 weeks.
Nike reported today, so early earnings, they were up 10%.
Up 10%. Okay, well, this helps my thesis. Q3 earnings will end the streak of negative earnings quarters. I think it's been 3 in a row, and turn positive. So, looking at FactSet, which is always comprehensive in its earnings coverage, right now the prediction is for minus 0.2%. So slightly negative prediction for earnings growth among S&P 500 companies in the third quarter. Now, last quarter, the prediction was for minus 7%. And ended up coming in closer to minus 5%. Not good. It was, negative growth, but not as dire as was expected. So I think the same thing will happen here. And, maybe Nike is a sign of, things to come. I think it'll turn positive. I don't know how positive, but I think, it doesn't take much to go from a minus 0.2% prediction to, plus 0.1 or whatever. So I think, again, earnings will be less bad than expected, and hopefully there will be some actual growth this time. I think there will be.
I hope so too. I don't necessarily expect it. I'm more in the bear camp lately, and I know I can sort of flip flop. I tend to catastrophize. Uh, but I would certainly hope to see some earnings beats. I didn't see the specifics of Nike's numbers. I just saw they were higher on an earnings mix.
Mhm.
Uh, do you think that it's going to be more sector specific or is it going to be broadly that the economy is just humming along stronger than we
I think
thought it
that
was?
economy keeps coming in stronger than people expect generally, not in every single metric. I know unemployment's up a little bit. But so for one, Q3, a lot of it, at least up until the last few weeks, a lot of it has happened before the big spike in oil prices. And we just talked about the just giant travel boom. I mean, that's one area where, travel, leisure, those are areas where they just keep exceeding expectations. And, this was Q3 includes summer. It's, July through September. So July, August in particular, are I think are going to be, big numbers there. But I think it's more across the board. I'm sure there'll be some sectors that actually do have negative growth.
Hmm.
Um, but I think it'll be enough to, end the streak of 3 straight quarters of negative growth.
Yeah, that's a smart perspective is seeing that those sort of knock-on effects that would be lagging in the earnings. I was looking at Nike's report just now. They missed on revenues. They beat on earnings by 25%, mostly on higher margins. US sales were down about 2% in the quarter. So that's something that we've been sort of talking about with the consumer spend. Chinese sales up 5%. Sales in all other global regions were higher, and Nike's margins were better as well. So if we're seeing a resolution to some of those supply chain things that were the hiccups and the issues that we're still sort of dragging into some of these bottom lines, then I think that definitely makes a bull case for your improving earnings conditions.
Yeah, it's supply chain. We're not hearing about the supply chain issues nearly what we were hearing a year ago or prior to that. And also, you mentioned China, just, these big multinationals like Nike that do business in China. I know China has taken some flack for not, having the growth that people expected coming out of its lockdowns, but it still was what, 6% GDP?
Yeah, like 6%
growth.
GDP.
So it is growing better than the US. So I think China's only going to be an assistance to some of these multinationals in terms of earnings growth in the third quarter.
Yeah, it may make sense to prioritize either large multinationals or international companies, maybe not emerging markets as much as some of the established first world economies. Can't really touch the UK, and Europe's got the Ukraine stuff. So maybe Japan. We had talked about maybe talking about Japan as a possible topic and trying to get Carl on. So maybe look to some of the large multinationals and look overseas if the US is weakening like Nike's results showed. My first sure to be wrong. Yeah, my first sure to be wrong prediction: oil closes the year over $100 a barrel. Seasonality is not really a winter issue for oil. Looking back over the last 75 years, it's on average up about 3% in the October, November, December months combined. So in the aggregate, it's higher there, but it's very much a coin toss. 50% higher in October, 50% higher in November. The percentage of the months that it closes above the opening price, right? October, half the time it's higher. November, half the time it's higher. December, 60% of the time it's higher. So there's not a lot of takeaway there. It's very much a coin toss. But
$91 a barrel right now, so it wouldn't have too far to go, up from like 70 a month or so ago.
Yes, it doesn't have that far to go. It was as high as 94, 97 earlier this month. So it's certainly within striking distance, but the U.S. strategic reserves are lower than expected right now. Russia has production problems that they're sort of couching as being voluntary restrictions with the Saudi cuts continuing and inflation sticking around, I think that maybe it's like 70-30 that oil moves higher from here, is in my mind at least, but I think that oil closes the year above 100 a barrel.
The great thing about this prediction is one of us is bound to be wrong, because a few months ago, one of my takes was that Bitcoin would hit 40,000 before oil went above $100. Bitcoin, I think, is down since then. It was like 29,000 when I made this prediction, and oil was right around 70, I think, maybe lower. Bitcoin's down to 26,000 since, because this is probably right before things, the sell-off commenced in August and September. My premise was Bitcoin's a bull market play, and oil, of course, it's not $100 yet, but it's trending that way. So if you get this right, it'll mean I'll be wrong. So one of us is drinking hot sauce at our next hot sauce punishment podcast, regardless. Okay, my number 2 is that the Fed will raise 25 basis points in November, but by then, no one will sweat it too much. Right now the Fed feels like it's looming over everything. It's back, not quite to the fear we saw last year or even first few months of this year, but it's back in play in a big way, and a lot of things, the market feels more Fed dependent than it has been in a few months. The Fed did raise 25 basis points over the summer, and no one really batted an eye at that point because stocks were rallying. When stocks start rallying, when sentiment changes, the Fed can be more easily tuned out. Now, not if they continue raising it, another 75, 100 basis points, even 50, I think would not be a good thing for the market. But, what is it, about 50-50 on whether they're going to raise again in November. I think by that point, I think the market will be in a much better place. Sentiment will be a much better place than it is now. And I don't think people will worry too much about it. I don't think it's going to result in a pullback like we saw 2 weeks ago. What really triggered this 5% pullback in the S&P the last couple of weeks was the higher for longer comments by Powell a couple of weeks ago, saying that they intend to hold rates higher for longer, like well into next year without any cuts. And so, market didn't like that, but I don't think we'll be as Fed focused 6 weeks from now.
So looking at the CME FedWatch tool right now, markets are pricing in a 17.3% expectation for a hike in November, and an 80
only 17. Wow.
Only 17, 82.7% that it stays where it is. And I think one thing that you might not be seeing is the government shutdown limits the SEC's ability to monitor and gather additional information. If we have a government shutdown that lasts, say, 3 weeks, or let's say 30 days, right? So it's the entire month of October. The Fed is losing information gathering capacity for that time. With as much as they've been talking about, like, we're going to wait and see, we'll see what the data says. And with the fact that they've already priced in one more hike, my bet would be on, if there's a hike, that it comes in December. Now, if we avoid
there's 65, or sorry, 30% chance, 31% chance that they'll hike in December is what it's saying. So that it's still not 50%, but
in the aggregate, it's it's close to it, right? It's 48.4% expectation of a rate hike. So it's about a 50-50 call that they hike again this year. Right. But I think the market is favoring the odds in December, largely because of Jay Powell's tone, and because of that limited visibility and information gathering. It's also a really convenient excuse for them to come out and say, "Hey, we just couldn't see enough information, so we're gonna leave rates where they are," and hopefully throw a bone to the bulls in the market.
Yeah. Well, I think regardless of whether they do or don't in November, or December, especially December, I don't think it'll put a big dent in, in the market like the way it did 2 weeks ago. I guess
Yeah, it definitely that supplemental material with the higher rate height with the higher terminal rate guidance for 2024, that was the bucket of cold water on the market. The mechanics of how they get there is not going to be the big surprise for the market.
Yeah. Okay. What's your number two?
My number two, S&P closes the year in the 3,900 range.
Okay. So just full disclosure, Brad and I intentionally did not compare notes on our predictions. So you go ahead. You beat me to the punch. Go ahead.
Okay. So we've been talking about weaker U.S. consumer spending. We've been talking about persistently high interest rates. I mentioned the Schiller index. Fair value should be close to 3,000.
You said again, you said we'll close around 3,900 range.
I'm going to say in the 3,900s. So between 3,900 and 4,000 is where I'm pinning us at the end of the year.
Okay, good. Actually, this is good. Okay. So your 40 dips below 4,200 take isn't just a briefly dip for 4,200. You think it'll stay down, be way below 4,200 and stay there through the end of the year?
I think at the end of the year, we will be in that position because if we've got the bad optics of the potential government shutdown, and then you've got no Fed hike in November, and you've got the Fed hike on the calendar coming in December, right? At least the market pricing in that expectation. And then you've got funds window dressing and closing out positions for year-end tax selling. On December 31, I could see some negative momentum with maybe some tax loss harvesting, right? If you bought Nvidia and Tesla and you have big gains on it and you close the position, you're going to need some losses. And because there's not been a ton of institutional trading this year, the losses aren't coming from your sort of normal operating activities. So you have to engineer them, which I think is going to be particularly bad for the month of December. So I think that there's some possibility of like not even a structural weakness, because it doesn't mean that the companies are doing poorly, but I think there's going to be a confluence of some underlying structural events going into the end of the year that's going to pull the S&P down.
All right, this feeds perfectly into my number three. I don't even need a rebuttal because this is my number three. The S&P will hit new highs by the end of the year, which would mean 6.7% growth from here. Okay, so here's my case. Even though I agree with you, it may go below 4,200 before that happens. There's a stat from Ryan Dietrich, Carson Research Group, who we often cite, really good market historian. There's 9 times since 1981 the S&P has been down in both August and September. 9 times the market has been up in Q4 by an average of 9.1%. So that's pretty good data. Does it mean there's a guarantee that it'll be 10 for 10? No. But I think, as our Mike Santola wrote last week, market bottoms tend to happen in October. The last one was last October. It was when, as we said, the bull market began technically middle of last October after it bottomed. I could see, I think your piece where you said earlier that it'll dip below 4,200, especially with the government shutdown, will be right. I don't think it'll dip too much below that. And I think we'll see the rally start sometime in October. May depend on the government shutdown, how long it lasts, may not. And I think we're going to be up. First, I thought you said 4,900, so I thought you were truly stepping on my take. No. I don't think we'll be up that high, but I think what you said about breaking above 4,500, I think that'll happen. I think possibly even higher than that by year's end. November, December, you mentioned tax loss harvesting. November, December, or and you can debate. We did debate a couple weeks ago seasonality. How much it matters, but November, December are historically the 2 best months on the calendar. I know there's a lot of headwinds right now, but I think stocks, again, we're in a bull market that just sort of came to fruition, turned to 20% up in May. Those don't tend to just up and fizzle. So I think we're going to be at new highs by the end of the year.
Yeah, let me caveat this a little bit. I think you are probably more likely to be right than I am. For me to be right, we would have to break through the 200-day moving average to the downside. We would have to blow through 4,100, which was a support level for, March, April, May, or it was sort of the consolidation range for March, April, May. And we would have to head back to the lows of the February and March period. So we would essentially have to reverse all of the good news done, or all of the good work done so far this year, for me to be right. For you to be right, the market just needs to go up a little bit and reestablish a position above the 50-day line. And it doesn't even need to achieve all-time highs or even 2022 highs, right?
Yep.
Like it could set new 2023 highs and still be below the peaks of 2022 and still well below the peaks of 2021. So it's not a challenging track for the market to rally to those levels. It would be a much more challenging path to break below 3,900, and it would require concerted selling and really essentially no good news. So I think odds favor you being right on this one over me.
45.88 was the end of July high for the S&P. Sorry, and we're down 6.7% from that. That's the high. I think. Will we exceed the all-time highs from what late 2021? Probably not by year's end, but what I mean is 2023 highs. I think we will hit new 2023 highs before year's end.
And so you need up 6%. I need down 8%. Yours, I think, is less challenging. A little bit of good news could reverse that pretty quickly. I mean, even if we avoid a government shutdown, and then the Fed in November says we're actually done hiking rates, our terminal rate for the year is the 5.25 to 5.50 that we've been at, the market's going to rally 10% or 15 or 20. Like, who knows how high it runs, right? And the consumer sentiment is already, or investor sentiment is already really low. You would need either just a grind lower over the last quarter or some unexpected bad news for me to be right here.
Okay, you have one last take. It's not market related. It's near and dear to your heart, and your it's a local take for you.
It's local. Diamondbacks will win the most games in October.
Of the three major teams. Phoenix sports teams. Or wait, does the Coyotes still have a team there or no?
The Coyotes still have a team.
Okay,
of the three major, not a ton of followers. I did a spell following hockey, but D-backs currently in the wild card for the Major League Baseball playoffs. Cardinals not fielding a team this season, despite somehow beating the Dallas Cowboys last week. My official stance is still there's no team on the field, and the Suns will start play at the end of October. So
they're one of the 3 or 4 Vegas favorites to win the NBA title this year, I think.
I would assume so. I think
they're third when I last saw, behind the Bucks now that they have Damian Lillard. But and so how many? Okay, so let's do the math on this. So how many games do each play?
So the Cardinals and the Suns are both guaranteed to have 4 games. The D-backs could play 2. They could play 3. They could play none. They could play 5, or they could play 8. Right? That's
okay. There's 3 games left in the regular season now.
I wasn't even thinking about regular season play. I was just thinking postseason play.
Oh yeah, so Sunday technically would be an October game. That's October 1st is Sunday. They're in the driver's seat in terms of one of the wild cards.
They control their own destiny to make the postseason. I think their magic number is down to 1. The Cubs drop. They had an unfortunate rain delay that probably led to a loss and mixed up their pitching rotation a little bit heading into the end of the season. But But I think the D-backs come out of the wild card round and win probably 2 more regular season games, one of those coming in October. So that's 3 wins right there. If they can then steal a win in the division series, that puts them at 4, which the Cardinals are not winning 4 games, and the Suns might, but going
Although
3-1 to start the season with the new rotation, with lineup changes now happening 3 weeks before or a month before play starts. Give me the D-backs to be the winningest Phoenix sports team in the month of October.
Okay. We'll come back. We'll come back to that one at the end of October. We may know the answer in like a week.
Yeah, the D-backs could miss the playoffs tomorrow. Not tomorrow,
or not win their first. I think they would play. Looks like maybe the Phillies first round, which would be tough on the road, I think.
Or they could make the playoffs and drop both games
right.
in the wild card round and not advance out of there. So they could be 0, but my money's on them to be the winningest Phoenix team.
Okay, good take. Okay, well, that's a good place to end things on a lighter note. As always, these are, as we said, these are predictions sure to be wrong, but because a couple of Brad's and takes and mine essentially contradict each other, that makes it confusing for you. So you got to pick who you think will be wrong.
That's how we make a market.
Yeah, exactly.
I'm in bear mode right now. I've re-entered bear mode after our failed breakout.
I did not see that coming. 39. That's why I thought you said 4,900. 3,900. I did not see that coming. I'm glad. That was perfect timing with the yin and yang between our 2 picks. Okay, we got to get out of here. We will see you next week on Street Check. And hopefully the market is near a bottom, and hopefully the government shutdown doesn't do too much damage. We'll know by this time next week.
Bye.